This video covers distribution and retention policy, which is another crucial aspect of strategic financial management in a company. We will start our analysis by first discussing the theoretical stance on the irrelevance of dividends. Next, we will present arguments showing why this theory does not hold in practice. Finally, we will review the main factors which companies take into account when formulating their dividend policies and analyze typical practices in this field. The classic view on dividends, developed by Miller and Modigliani, states that it should be irrelevant to shareholders if they receive dividends or not, as long as the company invests its retained earnings in projects with a positive net present value or NPV. The rationale for this irrelevance assumption comes from the fact that if a company invests retained earnings at the rate of return required by shareholders, then a missed dividend should be matched by an equal increase in the company's share price. So, assuming that the rates of return on projects into which the company reinvests its profits are higher than the rate of return expected by shareholders, then reinvesting should increase shareholder wealth. Therefore, in accordance with this theory, it is the company's investment policy that is most relevant to the creation of shareholder wealth, not its dividend policy. Although the theory sounds rational, you should be aware that it is based on a number of simplifying assumptions, which, among others, pertain to the irrelevance of external factors, such as taxation and the costs of issuing equity. When these assumptions are relaxed, the theory becomes invalid. This relates in particular to the issue of tax rates on capital gains and dividends, which in certain jurisdictions may differ, a fact which has obvious implications for shareholder preferences. There are also other arguments which undermine the validity of the irrelevance theory in imperfect financial markets. In reality, investors have specific preferences regarding corporate dividend policies. In particular, certain investors may favor current income, which they can use to finance current consumption needs. Such preferences are typically observed with reference to individual investors. However, institutions may also require a regular dividend stream to service their current obligations. As a result, there is a broad group of investors who prefer to hold shares of those companies which pay a regular dividend. Another argument against the irrelevance theory is a common belief among investors that a dividend is a safer form of income than a capital gain. That is because the realization of a capital gain requires selling shares, which exposes investors to share price variability. Finally, market participants often use dividend payments as sources of information regarding the financial performance of a company. This effect is referred to as dividend signaling. As you can see, dividend policy is clearly not irrelevant. In fact, a dividend policy is one of the key elements of any corporate financial strategy. Let's now discuss the factors which companies take into account when deciding on their policies regarding dividend payouts. The first of these is dividend capacity, which is understood as the ability to pay dividends to shareholders. First and foremost, dividend policy is a function of a company's profitability and the availability of free cash flows. Generally, the more stable the earnings of a company, the greater portion of its profits may be paid out to investors. Dividend capacity also depends on the availability of other funding sources. If a company is not in a position to issue debt to finance its investments, it will be forced to a greater extent to rely on retained earnings as a source of finance, and as a result, its dividend payouts will be reduced. This relates in particular to fast-growing companies, which typically reinvest their entire earnings. It should also be mentioned that the ability to pay dividends may be subject to specific regulatory limitations across jurisdictions and industries. Such limitations may relate to maintaining a certain level of profitability as well as minimum levels of capital below which entities are not allowed to pay dividends. Other factors impacting dividend policy relate to the economic environment in which a company operates. One of the most important aspects is the level of inflation. This is due to the fact that dividends are based on the historic profitability of a company, typically the after-tax profit for the year preceding the dividend decision. Therefore, paying out dividends in periods of high inflation may lead to the erosion of a company's capital. Let's now review some common examples of dividend policies adopted by companies. The first policy is one of stable dividends, under which a company pays out a fixed or growing dividend each period. Such a policy is particularly attractive to investors with a strong preference for predictable current revenue, and is typically adopted by mature companies with stable profits. Please note that under this policy, a company may find it difficult to maintain a stable level of dividend in periods of reduced profitability. A specific type of stable dividend policy is the so-called ratchet pattern policy, where dividends are paid out with a time lag relative to the earnings achieved, which allows for the level of dividend per share to be maintained even in periods of temporary decreases in profits below the dividend level. Another dividend policy is associated with maintaining a constant payout ratio, under which a company pays out a constant portion of earnings achieved each period, while the remainder of those earnings gets reinvested. Under this policy, the level of dividend per share will naturally fluctuate from period to period. On the contrary, under a residual dividend policy, the company pays out only the residual portion of earnings, which is not reinvested in the company's investment projects. The major drawback of this policy from the point of view of shareholders is an even lower predictability of future dividend levels than in the case of a constant payout ratio. On the other end of the spectrum of dividend policies is the zero dividend policy, where no dividends are paid out to investors as the entire profit is retained and reinvested. This policy is often favored by companies during the growth phase and ought to be changed when the company's business matures and cash starts to accumulate. As you can see, the choice of any particular policy listed is associated with a trade-off between the ability to preserve cash for reinvestment and the fulfillment of investors' expectations regarding the realization of current profit. There is, however, a dividend scheme which allows for a reconciliation of the two needs, and it is referred to as a scrip dividend. A scrip dividend is a scheme under which an investor may choose between receiving a cash dividend and being awarded new shares of the company. Accordingly, those investors who have a lower preference for liquidity and who believe in the value creation potential of the company's investment projects will choose to receive shares, whereas investors with a preference for current income will rather opt for a cash dividend. Please note that scrip dividends allow shareholders to increase their capital involvement in the company without incurring brokerage costs. A potential disadvantage of scrip issues is that when used excessively, they may potentially lead to the dilution of ownership. Finishing our discussion on dividend policy, we have to mention share buyback schemes as an alternative to paying out dividends. Share repurchases are typically carried out when a company has a large cash surplus that cannot be invested in an NPV positive project, and management decide to return this cash to shareholders. Obviously, this surplus could be paid out in the form of a dividend, but a share buyback has a number of advantages, both for shareholders and for management. The most important argument in favor of share buybacks from the perspective of management is that a share repurchase increases the company's share price, by which the company sends a positive signal to the market and also becomes less prone to a takeover. What is more, the shares which are bought back get cancelled, which increases the company's gearing ratio and impacts its cost of capital. From the shareholders' point of view, a buyback gives them the option to either sell their shares back to the company and realize a capital gain, or not sell and profit from future increases in the share price. Please note, however, that a share repurchase has to be allowed by a company's Articles of Association and usually requires consent to be granted by the general meeting of shareholders. As you can see, there are various approaches to dividend policy applied by companies, and different policies are adopted by organizations which are at different stages of corporate development. In other modules of the course, we will explore the topic of dividend capacity and learn more on developing a suitable dividend policy given a company's specific circumstances.